Credit cards. Picture this. Your card is full, you're at the checkout, your wallet is empty. But you swipe a piece of plastic and it all just works. The groceries, the new headphones, the tank of gas. It feels like free money. Then the statement comes. You owe $1,200, but the minimum payment is only $25. You think, no big deal. That is the trap snapping shut. Here's the deal. A credit card is just a tiny, always available loan. You're not spending your money, you're spending the bank's money, and they expect you to pay them back. With interest. The bank makes money from you in a few ways. There's the annual fee, just for the privilege of having the card. There are merchant fees, which they charge the store every time you swipe. But the big one, the killer, is interest. If you don't pay your full balance every month, they charge you for the pleasure of owing them money. That interest rate? It's called an APR, and it can be 20%, 25%, even 30%. That's loan shark territory, but with a shiny rewards program. Now comes your credit score. Oh boy, that little plastic card is the fastest way to build it and the fastest way to destroy it. Pay on time, your score goes up. Miss a payment, it gets nuked. Max it out, you look desperate to other lenders. It's a game where the rules are written in fine print, and the house always wins. I get that credit cards are dangerous, but they're not all bad. Used right, they're safer than cash, they build your financial reputation, and they can even pay you back in points or cash. But you have to remember, it's not your money. It's a loan. And every loan comes due. Retirement. Let's talk about retirement. I know. Feels a lifetime away. You've just started your career, you get that first paycheck, and you see a line item for something called a 401k. It's easy to see that as money you're losing, money that's locked away for a future version of you that you can't even imagine yet. But I want you to try and shift your perspective. What if I told you that isn't money you're losing? That is, without a doubt, the most important money you are earning. It's not for the person you are today, it's for the person you're going to become. I want you to stop thinking of your 401k as a locked box. I want you to start thinking of it as your most loyal employee. An employee that works 24/7, never takes a day off, and whose only job is to build your wealth. That $200 you contribute this month? You're not just setting it aside. You're hiring a new worker. You're putting it to work in the market where it has the potential to grow and, crucially, to start earning its own returns. This is the magic of compound growth, and your greatest advantage isn't your income, it's your time. Time for that money to double and double again, turning the disciplined choices you make today into genuine financial freedom tomorrow. The stock market. Imagine you buy a single share of a company for $100. A year later, it's worth $107. But because of the market. The stock market is a giant, global auction where pieces of companies are bought and sold every second. When you buy a stock, you're not just betting on a price. You're buying a tiny, tiny slice of a real business. When the company grows, your slice becomes more valuable. When it struggles, your slice shrinks. There are two main forces at play. Bull markets are when everyone is optimistic, prices are rising, and it feels easy. Bear markets are when fear takes over, prices fall, and it feels like the world is ending. Let's say you panic sell during a bear market. You just turned a temporary loss into a permanent one. On the flip side, buying and holding through the fear. That's your portfolio building resilience like a muscle. $100 becomes $75, then $150, then one day you wake up and that initial fear seems silly. This is why the market is the ultimate test of patience and emotion. For traders, it's a roller coaster of adrenaline and panic. For investors, it's a slow, steady escalator to wealth. So, what's the hack? If you're emotional, you'll lose. If you're patient and consistent, you'll almost certainly win. The market is either a casino where you're the sucker or a tool where you're the architect. The choice is in how you use it. Budgeting. Okay, so you get paid, you pay your rent, you buy some food, you go out with friends, and by the 20th of the month, your account is blinking red. You check your transactions and see $100 spent on subscription services you forgot about, $200 on delivery apps, and you realize you've just been hit by a lack of a budget. Budgeting is what happens when you tell your money where to go instead of wondering where it went. Not a restriction, not a punishment, just a plan for your cash. Your $3,000 paycheck is still technically $3,000, but without a plan, it buys less security, less progress, and doesn't actually work for you as hard as it could. So, what actually causes the bleed? Sometimes it's death by 1,000 cuts. The $5 coffee, the $10 lunch, the quick Amazon purchase. Let's say you skip making coffee at home 20 times a month. That's $100 gone, evaporated. You get a raise, so you get a nicer apartment, a newer car, and you're just as broke as before, just on a higher level. Or sometimes just cause. Not tracking it at all is a guarantee it will disappear. A little budgeting is normal, even empowering. Knowing where every dollar is going, that's control. But if you ignore it, goals die, debt builds. You try to fight it by making more money, but without a plan, more money just means more spending. The economy. The economy is just a fancy word for all of us, buying and selling stuff from each other. One day it's booming, everyone's hiring, houses are selling, you feel confident. But then a shift happens. Maybe a war, maybe a pandemic, maybe people just stop buying as much. In a downturn, confidence vanishes, hiring freezes hit, and everyone holds onto their cash a little tighter. Why does the economy cycle? It could be a range of things. Could be inflation getting too high, forcing the government to raise rates. Could be a bubble in housing or tech finally popping. Could just be the natural rhythm of things. Expansion, peak, contraction, trough. Think of the economy as a seasons. In the summer, everything is growing, vibrant, hot. But eventually, fall comes. Leaves fall. Things cool down. Winter is harsh, everything is frozen and dormant. But it never lasts. Spring always comes again. Growth returns, new buds appear, and the cycle starts over. These cycles aren't failures, they're features, painful ones. Businesses that were weak fail. Strong ones survive. It's a reset. Eventually, confidence returns, spending resumes, summer comes back, but not without lessons learned. Net worth. Your net worth isn't your salary. It's a cold, hard equation. You add up everything you own, your cash, your car, your house, your investments. Then you subtract everything you owe, your credit card debt, your student loans, your mortgage. That number, that's your net worth. This number isn't about income. It's about progress. It tells the real story of your financial life. The score has a range from massively negative to billions. Below zero, you're in the red, you owe more than you have. Over zero, you're building. Over 1 million, you've achieved something most don't. Most people are stuck somewhere between negative $50,000 and positive $100,000. How is net worth built? Assets. Things that put money in your pocket like investments or rental property. Liabilities. Things that take money out of your pocket like car loans and credit card debt. Income. What you earn. Spending. What you consume. Savings. What remains from the income after spending. All of these things are the ways it is calculated. But to actually increase it, you have to buy assets and reduce liabilities. It's that simple. You buy assets using either the savings or borrowings. Your net worth is like a financial report card for your entire life. Ignore it and you might be driving a nice car but own nothing. Focus on it and someday you might actually be free. It's not about looking rich. It's about building real wealth. You can have a high salary and still have a trash net worth if you spend it all. So yes, the game is about what you keep, not what you make. But if you learn the rules, you can win it. The weird part about debt is that it's not inherently evil. Humans created debt to leverage the future for the present. Debt makes big purchases possible. Makes it easier to buy a house or get an education. In saying that, there is no difference between a mortgage and a credit card balance. They are both money you owe. People believe a mortgage is good debt. And maybe it is, but only because the asset you bought might grow in value. The same can't be said for a vacation on a credit card. The only reason one debt is better than another is the value of what it purchased. So how does debt actually work? Well, a lender gives you money. You promise to pay it back with interest. The reason interest exists is to compensate the lender for the risk they took on you. If you take on too much bad debt, then the interest payments kick in and your paycheck becomes a vehicle for making the bank richer. If you use good debt wisely, you can afford to build a life you couldn't with cash alone. Debt is a tool. A dangerous one, but a tool nonetheless. Saving. So you know what a budget is now. And the best way to make that budget actually mean something is saving. Saving is what happens when your money stops working for today and starts working for tomorrow. Instead of trading your money for instant gratification, you're trading it for future security. The problem is, it requires discipline. Where do you actually put it? Emergency fund, cash for when life explodes. Short-term goals, money for a car or a vacation. Retirement, money for your 80-year-old self you hope is still cool. Of course, there are other buckets, but that's a topic for another day. Saving isn't about being cheap. It's about being intentional, prioritized, and patient. Most financially secure people didn't inherit a fortune. They just consistently put a little aside for decades and let it pile up. And yes, saving comes with opportunity cost. That's money not spent on fun right now. But the real danger isn't missing out on a few dinners out. It's never saving and watching an unexpected bill quietly destroy your stability. Leverage. This one is more complex, but everyone should understand it. Imagine you want to buy a $300,000 house. You don't have $300,000. You put down $30,000 and borrow the rest. That's leverage. You used a little of your money to control a lot of someone else's. The house's value isn't actually yours until you pay off the debt. It's worth more to you because you control the asset. Understanding this is what allows people to build wealth faster. If you can wisely use other people's money to buy assets that grow, you will earn a lot of money. Real estate investors don't buy buildings with cash. They use leverage to control multiple properties. They use debt to acquire something with a large potential for value. So the bank gives them millions of dollars for that bit of risk. It's the same reason businesses take out loans to expand. The value they can provide grows and they are willing to pay a price for that chance. Leverage is the same reason you can put a 20% down payment instead of the full price of the house. You amplified your deposit. If you can figure out how to use leverage wisely, even if it's scary, you can build a lot of wealth. But get it wrong and it amplifies your losses just as fast. Opportunity cost. Opportunity cost is the most valuable concept in the world. And the best part, every single decision you make has one. You just can't always see it. You probably make 100 choices with hidden costs every day. But no one gets unlimited options. Most people see money spent on one thing as just that. $50 on a video game. Simple transaction. The top earners see the lost potential. That same $50 invested for 30 years. And the difference isn't intelligence. It's perspective, discipline, and how well you've trained yourself to see the road not taken. But nowhere does opportunity cost work harder than in your daily habits. There is no greater force in life building. Not luck, not income, opportunity cost. Because wealth isn't just about what you do. It's about what you choose not to do so you can do something else. Money that is spent on things that lose value doesn't just disappear, it loses its potential to grow. Slowly at first, then it adds up. That's why ordinary people with modest paychecks can retire with nothing. They didn't lose it in the market, they spent it one small choice at a time. A little money spent consistently over enough time becomes a giant missed opportunity. The choice is always yours. We've covered a lot of ground today, from the fundamentals of budgeting to the profound power of compound growth. Remember, this journey isn't about perfection, it's about progress. Every small, conscious choice you make with your money is a step toward a more secure and confident future. You have the power to build the life you envision, and it starts with the knowledge to make informed decisions. If this video helped clarify these concepts for you, or if you have your own tips to share, we would be truly grateful if you left a comment below. Let us know what you'd like to learn about next. Your support is what makes this community so valuable. If you found this helpful, please like this video and subscribe to our channel. Together, we can continue to build financial literacy and create a brighter future, one step at a time. Thank you for watching.